Okay. Well, speakers, I'm very sorry not to be there in the room, but look forward to meeting you when I'm back in the Bay Area. I hope sometime soon. And everyone, welcome to this week's CEDAR seminar. I'm Lisa Goldberg, one of CEDAR's co-directors, and I am coming to you from Princeton, New Jersey today, where I don't usually stay, but there we are. I am delighted remotely to introduce today's topic and speakers. The speakers actually come from a wide range of institutions: Federal Reserve of San Francisco, Hamburg, Brookings, NYU. The topic, very timely for all sorts of economic and political reasons: the effect of U.S. climate policy on financial markets, an event study of the Inflation Reduction Act. So before I turn it over, I have a question. Do you prefer we hold our questions to the end, or should we have more of a dialogue?
Let's have more of a dialogue. People should jump in with their questions. Yes.
Okay, well then we will feel free to do that, and I will turn the mic over to you.
Thank you so much, Lisa. Thanks, Robert and Lisa, for the invitation. I'm Michael Bauer from the Federal Reserve Bank of San Francisco, and my co-authors, Sven Rudebusch and Eric Offner, are here too. Okay, so this paper studies the effects of a big U.S. climate policy announcement, which, funnily enough, is called the Inflation Reduction Act. But really, the big part of this legislation was, of course, as everyone knows, the biggest climate legislative package in U.S. history. So let me just adjust this a little bit here. So a little bit of the big picture. Okay, so it's a consensus that to prevent too much global warming, we need the entire financial system to support this green transition, right? This is a quote from the Glasgow Financial Alliance for Net Zero that emphasizes that every company, bank, insurer, investor will need to make some big adjustments in this transition, right? So financial markets are going to play a really vital role for addressing climate change. In this climate finance literature, we're kind of really thinking about three aspects or three roles that financial markets play. Of course, the most obvious one is that they allocate funds, right? The big investments that are required to transition to a low carbon economy are going to come from and through financial markets. But financial markets will also provide information about how people value different paths to the low carbon economy, different risk exposures, about investors' preferences. So you can look at financial market data and learn some important things related to climate change and the green transition. And here, let me give one example. Glenn and I, we have a paper on social discount rates, which are really important when you think about the value of emitting carbon emissions. You want to kind of value these future damages that you avoid and calculate present values. And to think about social discount rates, you can use financial market data to estimate them. So this is just one little example in this area where financial markets provide information. And then, of course, they help manage risk. They there's compensation for risk, and you can hedge climate-related risks. So these are the big three areas, and our paper, we'll touch on all of these in some way. So most of you may know this already, but just as kind of a brief reminder, the two broad categories of financial risks related to climate change are physical risk and transition risk. Yeah, so you have physical risk being the direct impact of climate change. So think about droughts or storms, flooding, heat days, and extreme weather events. So all of these are risks to the economy and to asset value. And then there's the transition risks that are the result of this process, this transitioning to a low carbon economy. And so they're very uncertain, and they're the result of policies and regulations and technologies that we're going to need to reduce emissions and to combat climate change. Okay, so we'll focus a lot on the transition risks in this paper. For financial markets, different risks are relevant: equity bond markets, real estate markets, other asset markets. Like if you think about real estate markets in coastal regions, they're really exposed to physical risks like flooding. If you think about the stocks of an oil company, that's really exposed to transition risks. Their carbon tax, for example, that would have a big impact. So you got to think about both of these broad areas of risks. And it's hard to quantify them, to get a handle on them, because things are changing so much. So we learn more about physical risks. We have new scientific insights, new scientific results, and about the effects of higher temperatures on our planet and our economy. It's really hard to estimate what these climate change effects do in terms of economic damages, but there's a lot of research going on there. And then also things are just really changing in the political landscape, in the public perceptions about the green transition. And so that's why these are extra challenges to deal with these risks and to quantify them. And so we have more and more papers, an explosion of papers, I'd say. But because this is so difficult, you still actually have substantial disagreement about some of these things. Okay, and I'll mention a couple here. So let me really zoom in on the transition risk, okay? Because this paper is about transition risk. So the transition path to a low carbon economy, reducing our CO2 emissions. This path is very uncertain. And it is really dependent on policies. So how exactly the policies will be implemented and what the political realities are to make this happen are shifting all the time. And so you have these two difficulties with the transition to a low carbon economy. Investor expectations can change really quickly, right? If you have a new party in power in a big country that's, has a platform of climate policies, things can change very quickly. And in the US, as I'll show you, things changed very quickly depending on one vote in the Senate. So that's one particularly prominent example of how investor expectations can change. And there's a risk that they could change so much that it could be destabilizing for the financial system. Like if we had all of a sudden both parties in Congress agree that we need a substantial carbon tax, then you might see massive revaluations in asset markets, and we could see what's called stranded assets, so carbon intensive assets becoming basically worthless. So people have been talking about this the possibility of a climate Minsky moment, where you have financial instability because of sudden changes in transition risk, or sudden realizations of transition risk, rather. Right. So I think this term was coined by former Bank of England Governor Mark Carney a few years back, and so it's a question in this literature. Whether that's a real possibility. Okay, so now the Inflation Reduction Act was the largest climate policy in US history. Its estimated fiscal costs are $1 trillion over the next 10 years. It provides new tax credits, direct incentives, and spending for US households and firms, with the goal of decarbonizing our economy. And these estimates of $1 trillion, they are extremely uncertain because some of these tax credits are not capped, or actually most of them I think are not capped. So if the take up is stronger, then you would end up with potentially much higher costs, right? So So very big, but also unclear how big exactly it will be. This legislative package does not contain a carbon tax. Okay, we should be very clear about this. There's no emissions trading system or a direct carbon tax. It is really based on subsidies and tax credits to provide incentives for green technology. But there's still the expectation that it will reduce carbon emissions, and quite significantly, actually. And then you can make a kind of a calculation, like a hypothetical calculation, how big of a carbon tax would this be equivalent to? And what carbon tax would you need to achieve the same reduction in CO2 emissions? And people have put a price tag of $20 per ton of CO2. So not, the order of magnitude that we're now estimating would be optimal. Like some estimates out there for what would be the optimal carbon tax right now from the Biden administration, for example, are, I think, what's the current estimate for the social cost of carbon? I mean, it's like over $100, right? I mean, and some people think it should be even higher, right? So it's far off from that, but it is significant, right? So there's these projections that it would contribute to a substantial reduction in CO2 emissions.
Can you give a rough equivalent in terms of cents per gallon of gasoline or? That's okay. No.
I would have to really wild guess this because I don't know, but yeah, I think if you put a $20 tax on carbon, you would probably have $1 or $2.
No, I think it's more like 40 cents.
40 cents. 40 cents.
Something reasonable.
Okay, yeah, exactly. You would get, if you put the social cost of carbon as $150 per ton, then you would really get a couple dollars per gallon at least. Yeah. Okay. So the IRA's passage was a great case study for studying transition risk because it was so sudden. There was these big pieces of news. There was this even partisan split in the US Senate with 50 Democrats and 50 Republicans, right? And then you had Vice President Harris casting the 101st vote. And so you have 51 Democrats, but you need all of them, right, to pass legislation in the Senate. And so including Senator Joe Manchin from West Virginia, thank you. He was a pivotal vote. And so those big headlines in July, the first one on July 14th was that he categorically ruled out supporting any new spending for climate policies. Okay? And so that was basically the nail in the coffin, it seemed like at the time, for climate legislation. But then 2 weeks later, the Senate Majority Leader Chuck Schumer and Senator Manchin made a big announcement saying, actually, we do have an agreement. And they unveiled what they then called the IRA, new label, but a lot of the same things that they have been talking about for a long time. Right. And so both that it was a very big package in terms of dollar amount and estimated impact, and that it was so sudden in terms of the news, make this episode really ideal for conducting an event study. That's what you need for a good event study, as we know from the empirical asset pricing literature. Okay, so then we're going to use this event study as a tool to study the financial market response to news about the passage of the IRA, right? So we'll look at financial markets because they are forward-looking and they will give us some idea about what the expected effects, the expected economic and financial effects of the IRA are, right? So, this really is a major realization of this transition risk. So there's a lot of studies that try to estimate the effects of transition risk using like changes in measures of transition risk. You can use text analysis, you can use, you know, asset prices of certain, you can compare different assets that are presumably differentially exposed to transition risk. But what makes this this study unique is that this is not the perception about transition risk in the future. This is the transition happening on July 27th, basically, right? Where there's major news about the, you know, the future course of the U.S. economy. And so what's important is that it's really going to affect different firms and sectors differentially, of course, and that's what we're going to study, this heterogeneity across firms and sectors. The specific questions we're going to ask are, did stock prices react to this piece of news about climate policy? And, you know, it's not so clear. Maybe they expected it, and it was all priced in beforehand, and they wouldn't react to the news, or maybe there's just not a big expected effect. They don't think there'll be a lot of take up of these subsidies. It's not going to do any impact. These estimates are way off. So to study what investors, you know, whether they're really where they put their money on the line, to study the financial market effects will give us an idea of the expected effects of the IRA. And the heterogeneity that we're really going to focus on is, you know, both across different industries, but also across green and brown stocks. So meaning stocks that have low or high emissions. And I'll tell you how we measure this exactly. And then, you know, there's different ways to measure this. You could use emission levels or emission intensities in a different way. And then there's E-scores from this whole ESG literature, emission scores, E-scores. So in some sense, we're also going to use this as a kind of reality check on how well these different green scores differentiate across stocks. And one underlying question is, you know, with this biggest climate policy package in US history, did we have something even remotely similar to a climate Minsky moment? Did we have some instability in financial markets? So is this something where we should be worried about? Okay. So there's a huge literature in climate finance about, you know, everything I've talked about so far, about physical risks, transition risks, about the exposure of different assets, about using asset prices to learn about climate change. So the strands of the climate finance literature that this paper is most closely related is first, the pricing of climate transition risk in green and brown stocks. So there's a couple of papers by Bolton and Kasperczyk. I think this 2021 JP paper is called "Do Investors Care About Carbon Risk?" And we also have a paper on this, Glenn and I with two co-authors, about what's called the carbon premium. So there's some questions about how transition risk is priced in the stock market and how you differentiate between firms and how they're exposed to transition risk. And I'll touch on this a little bit. But you know, these are all kind of using long time series of stock returns, trying to learn about differences between firms. Here we're going to do something very different. We're going to look at these sharp revaluations of firms and focus on the heterogeneity there. There's some other event studies. So the Ramelli et al. Paper used the Trump election as an event. And that's interesting to look at that, you know, probably change the likelihood of future climate policy. And again, the big difference with our study is that this is actually the implementation or the actual arrival of the climate policy, and not some vague, you know, change in the probability of future climate policy. The Monasterolo and Angeli's paper looks at the Paris Accord, which didn't have a very sharp announcement and sharp changes in financial markets, so it's a little bit less distinct. And there's a couple other papers looking at changes in perceptions about future transition risk usually. And again, we see our paper is doing something quite a bit different with this realization of transition risk. There's a few papers that studied some climate policy action, about the Waxman-Markey Act is one of these papers. One paper is about something that happened in Europe, but nothing comparable in scale and scope to the Inflation Reduction Act. Okay, so a little bit more about this Inflation Reduction Act. So there was this timeline of events. There have been discussions about climate policy legislation already in 2020. Well, for a long time, but here specifically becoming more concrete with the climate legislation under the Biden administration started in 2021. The Build Back Better Act, but that kind of fell apart. And so then there was some more momentum towards the middle of the year, and thinking was pretty close to a breakthrough, and people had been working hard to get to a breakthrough in climate policy legislation, and then this Manchin news on July 14th really broke the back of that. So the negotiations at this point really collapsed, and it seemed like climate policy was due. There's news coverage from the day after. This happened, I believe, what did I just have here is the timing, right? It's like 9:30 in the evening. So the day after, New York Times, Washington Post, all had big articles saying that, this was basically putting the likelihood of climate legislation to essentially zero, right? So I think, heuristically, I'm thinking of this as, a likelihood, hard to know what the likelihood beforehand was, but 50-50, to closer to 0, 5% maybe, so you have, it's hard to know exactly, and we don't have in trade anymore. That, kind of online betting market fell apart, I think 10 years ago, and other betting markets somewhere else don't have this event that investors could put money on. So we don't know the probability, but that it was almost certainly a pretty big swing. But then the bigger swing from close to 0 to really close to 1 was on July 27th. That's when, just shortly after the market closed, Schumer and Manchin announced this new deal and this new title or label, the Inflation Reduction Act. And all the newspaper coverage that we looked at confirms the notion that this was a huge surprise, right? No one's really saw this coming. And so that's really important in event studies, right? If you have a firm's earnings announcements, that's clear. That's, you can compare the expectation and the realization of the earnings, and there's a surprise there. But here we have to be a little bit more careful and really dig through the news coverage and understand what was the surprise component here, and how big were these swings in probability. Okay, so let me just go back to the timing here. So both of these are after the close of financial markets, or after the close of the stock market. Some other financial markets are, of course, open around the clock. So what we're going to focus on mostly is here for the first event, which we have shaded in brown here, because it was kind of a bad news for climate change. So a brown event, if you will. So we'll use the close price on July 14th, 4 p.m. New York Stock Exchange, to the close price of the next day. You could use the open price, but there's really not that much liquidity then. So it's better to use close to close price. And so we'll do the 14th to the 15th, 24-hour return. And the same for the July 27th to 28th, because also there, the news came after the close of the New York Stock Exchange. Okay. Okay. I already talked a little bit about this, what's in the IRA, tax incentives, grants, loan guarantees. So what's interesting is, that people really have tried very hard to put numbers on what this is going to mean for our CO2 emissions. Extremely difficult to do, right? You don't know the take up, you don't know what how people are going to move from the old technologies to the new technologies, how quickly that's going to happen. But you have to try. And so the estimate that we have here in the last bullet point with the IRA, the carbon emissions by 2030 are projected to be around 37% below the 2005 level. In comparison, without the IRA, the projection is that we would be 28% below the 2005 level. The Biden administration has a goal, I forgot what the exact goal is, I think it was maybe 40%. So it really closes almost the entire gap between the most recent projections and the goal, although you don't get quite there. Okay, but really a substantial estimated impact on carbon emissions, despite the absence of a carbon tax or emissions trading system. Okay, and so here in the second bullet point, I was just reiterating what I said earlier, that many of these tax credits are uncapped, and so the budgetary cost could be a trillion, or who knows, they're uncapped, so the take up is really very uncertain. Okay, all right, so again, Brown event, the dramatic death of climate legislation on July 14th. And then the green event is the rebirth of climate policy, if you will, on July 27th. And I've tried to convince you that these two events are really quite ideal for assessing the financial market effects of climate legislation. And that this is a major climate policy transition realization. Okay, so just a little bit of the conceptual framework, something very simple, but just before we jump into the numbers, like what would we expect? Okay, so we have the simplest framework you can think of to think about stock prices, the Gordon growth model, right? So you have constant dividend growth, and you have a discount rate R, and you have next year's dividend D1, right? And so the price is just D over R minus G, right? So this model doesn't have any risk, of course, but as a heuristic, you can still think of this R, this discount rate, as having a risk premium. So stocks that are riskier, you would probably want to discount at a higher rate. And so you'd have a lower price, right? Because that R is in the denominator.
That implicitly assumes that once the Inflation Reduction Act is passed, it will be there in perpetuity or until it's whatever expiration is set in legislation.
Right.
And if you think about the prospect of a second Trump presidency, that seems uncertain.
Absolutely.
So the effect could be smaller.
Should be credited. Absolutely. And I'm not using this at all to quantify the effects. I think this is a perfectly valid argument. And so this is just kind of to think about which direction it would go. But yeah, exactly. Let's keep that in mind, right? So the main expected effect would be changing the profitability of firms in different ways. So their dividend growth. And that's really how we're thinking about this, right? And changing their profitability in two different ways. One is by lowering their costs. There's these production tax credits that are and investment tax credits for clean energy sectors and companies. So they will really help lower the costs of production and the cost of investing into new technologies, and they're going to help profits that way. And we'll call this a cost channel. And then there's a demand channel, of course. That's maybe the most obvious one. If you've recently thought about buying an EV, then you realize that you're actually you may be eligible for, I think it's a $7,000 subsidy to buy an EV. And as a little sidebar, there's an income requirement, right? If you make too much money, then you're not eligible for those $7,000. But if you lease the EV, a lot of the companies that are actually passing on this subsidy to the consumer. I know Audi does, and so many people are benefiting from this subsidy right away. And there's many others, for example, if you refurbish your home to make it more energy efficient, you benefit from subsidies. I'm not a homeowner yet, so I haven't looked into that as closely, but you can tell I'm leasing an EV. Okay, so that's the demand channel, right? And so that also helps green firms become more profitable. Although it's very vague. I mean, the law is very clear about where the subsidies are, but when I say green firms, it's not so clear exactly which firms are going to benefit from this. But we'll show you in the data which do. Okay, so here the thinking is then, okay, so these firms that benefit from it, loosely called green firms right now, they're going to see their prices rise because they have higher dividend growth, right? So that's the direction, but the magnitude, of course, is very uncertain. And this model has G be constant for forever, but there's a lot of uncertainty about how long that's going to last, of course. Okay, so it's very very dependent, the impact and the incidence of these subsidies, the impact on the profits and equity prices depends on the market structure, depends on segmentation. It's a very nice paper by Casey, John, and Traeger, new working paper that shows the impact of green subsidies across different types of firms and what that does to emissions. And they make the point that it really depends on the elasticity of substitution between clean and dirty energy and the price elasticity of demand for energy services. So if you want to go to the kind of firm level and really understand what these subsidies do to both emissions and profitability, you really have to think about the market structure and the technology. We're not going to go quite as deep. We have not a kind of macroeconomic modeling perspective. We're focusing on the financial market effects, but I did want to flag this very nice paper here that's thinking about these issues in a different way. Okay, so this is other possibility, right? So I had the dividend, different growth is G, and then there's the discount rate. And I just want to touch on that because a lot of this literature has thought about transition risk and the discount rate for stocks, green and brown stocks. And so there's a thing called the carbon premium hypothesis. And this hypothesis is that brown firms have higher expected returns because they're riskier. They're more exposed to transition risk. Think about big oil companies. If we get a carbon tax, they're really going to potentially suffer a lot from that. Stranded assets, oil fields that they own that become worthless potentially. So that's kind of a mainstream theory in climate finance now that these brown firms should have higher expected returns.
Excuse me, can I jump in here with a question? Mentioned before it was okay to do that. When we talk about sorting into green and brown firms, of course, there might be more than one way to do that. So it's kind of easy to think of ExxonMobil as a bad guy. But what about a firm like a healthcare firm that has a lot of hospitals that are making a lot of buildings that use concrete and cement, which consumes a lot of carbon? Or where in your taxonomy do companies like that go?
So there is a kind of a standard way to measure emissions on a company level, right? There's the scope 1, 2, and 3 emissions, these different categories. So scope 1 is basically exactly what the emissions you produce when you make your products. right? And scope 2 is the emission, includes also the emissions that are produced when the energy, the electricity that you use is produced, right? So very energy intensive companies that just get a lot of electricity from the grid, they would have high scope 2 emissions. And then there's the scope 3 emissions, which are the upstream and downstream emissions. So for example, a car manufacturer that may be pretty efficient in terms of how they make the cars, but then the cars go out on the roads and produce a lot of emissions. So that's a lot of scope 3 emissions, right? So this is a whole field of very relevant research trying to understand which measures are relevant for different purposes. And what we're going to do in the paper is relatively simple. We're going to focus on scope 1 and scope 2 emissions to classify firms, because scope 3 emissions are extremely hard to estimate, and they're much less reliable. If you look at the correlation of the scope 3 numbers across different data providers, it's actually quite low. So it's kind of more unknown, right? So versus scope 1, scope 2 is kind of more hard data. So kind of a pragmatic reason to focus on that. The hospitals, yeah, I'm not sure exactly. They use a lot of electricity, I'm sure. So that would be high scope 2 emissions. There's also, upstream emissions because they need to build the hospital.
Right.
So, exactly. So probably very low in scope 1 emissions, but potentially pretty high in scope 2 and 3 emissions.
Right. And we also have, and I totally agree with you about the caliber of the data. There's also a double counting problem and other stuff to deal with. But just in our thinking, right, the reason that ExxonMobil is producing all that oil is because we use it. So thinking in terms of the, especially for the transition, you might think you're thinking of which companies are going to fare better or worse in a carbon transition. Companies that are using the carbon, Exxon's going to do everything it can to pass on any prices to its clients, right? So would that be a potential kind of element to the discussion that you're making?
Yes. No, I think this is a great point. It's a related point is that firms that have high emissions like Exxon, they might actually, because they're experts in energy and because they're also not stupid, they might actually not be heard as much from the green transition if they're on the forefront of developing new technologies for low carbon energy production. So we always assume. So I guess that's just another layer to this, another subtlety to this. High emission firms, brown firms may suffer, but not if they are able to quickly transition their business models and just be on the bleeding edge of the green transition.
Totally. If you look at green patents, they're like all at Exxon. I mean, that's another metric people use sometimes. Not that that's such a good one either, but just I really like your framework very much. I'm just like always very worried about these rankings because I'm mistrustful of them. But anyway, I'm just wanted to enter that in the discussion and not disrupt further.
Is there anything you want to add to this?
We've got some follow-up work where we don't classify the firms. We look at the firms, how well they do, how well performance is, and then we examine whether it lines up with classifications of emissions and E-scores and
Yeah.
correlation there.
Yeah,
Yep.
just I listened to. Well, I'm very interested in this subject, and this is always on my mind when these subjects come up. I know everybody likes rankings, and we like to think in terms of bad guys and good guys, but I wonder if the subject isn't a little more nuanced.
Oh, it's so nuanced that we spend a lot of time trying to figure out what are good measures to use. Another huge aspect of this is the between industry and within industry variation. If you take something like CO2 intensity, it's a very common measure in this literature. You divide scope 1 plus scope 2 emissions by total sales in that year, you get emission intensity. You have dramatic variation across industries, but maybe that's not the right measure. Maybe you really want to focus on the firms that within their industry do really well, because some industries you just end up naturally necessarily producing more emissions. So the whole like within and between industry thing is a huge issue. And then you have the E-scores, right? So this is not too much of a sidebar because we'll be using these E-scores, and I can say something about them now, right? So you've got these providers, data providers, ESG data providers that go to the firms and ask them or evaluate them based on these criteria of, what's their plan for future emission reduction, how, what are their emissions, their emission intensities, and upstream and downstream, and so they have this catalog of questions, and then they come up with a score. For example, the data we're using has an emission score, an emission category score, and then they have some other categories in this whole area of environmental score, right? So that's the E-score, and all of these scores, they're pretty subjective. On the one hand, they're subjective because it depends on the question catalog, but on the other hand, they try to kind of look beyond just CO2 emissions divided by sales, right? They try to really understand the business models and the situation better, right? And they're always compared to peers in the industry. So every ESG score you ever see, according to our current understanding, is just relative to industry peers, right? So if some company has a really good E-score, it could be a very dirty firm in the oil and energy sector. It's just doing a little bit better than their peers, right? So, okay. So the most common way to classify firms is CO2 intensity or changes in emissions or level of emissions, all not so clear what the right measure is. But then some people find that brown firms seem to in fact have higher returns. And this Bolton-Kasperczyk paper is an example, but it really depends on the methodology. We looked at this pretty carefully, and over the last 10 or 12 years, which is really when you have the best ESG and emission data, it seems that green firms actually outperformed quite a bit. And so some of this are methodological choices and data choices, but we think if you do it carefully, that actually it looks like green firms did a lot better than brown firms. So there's this very difficult question of what is the support for the carbon premium hypothesis? And the challenge really is that you have these time series of returns, and not very long time series, but they could be affected by all kinds of factors. And in particular, expected returns don't need to be equal to average realized returns, which is a good assumption in empirical asset pricing when you have a half a century of data. But here, with the landscape shifting very quickly, and we only have maybe 10 or 12 years of data, it's not a good assumption. So in this event study, we can look at things a little bit more sharply, although we won't be able to say much about the carbon premium. But event studies allow you to isolate distinct movements in fundamentals. I would say that it's not clear how the climate policy legislation here would affect discount rates and the carbon premium. It really depends on what you think. Does this climate policy legislation make future climate policy more likely? Maybe if you're thinking the US finally showed that they can pass climate legislation, maybe they will in 5 years more pass a carbon tax. And I know that's not everyone's perspective, and it's maybe unrealistic, because the other view is that this is as much as they could do. They passed climate legislation as much as they could, and now they're basically done for the foreseeable future. And under that scenario, if that's your view, then there's not much transition risk left, so to say, and so then the carbon premium for the brown stocks would decline. Anyways, this is just a sidebar. It's really not clear what the effects of this climate policy is on the risk premium of brown stocks and discount rates. It's much clearer, I think, what the effects on future profitability is. Okay, but let me show you some results. Okay, so we're going to start by looking at stock indices for clean energy indices and oil and gas indices. These are commonly used to represent the green and brown energy sectors. They're going to be pretty focused on energy sectors. Then we're also going to look at industry portfolios, pharma French industry portfolios. Everyone knows those in empirical asset pricing. And we'll look at what do these indices and portfolios do, what are their returns around these events. 1 and 3 day windows is what we're going to look at here, and we'll use abnormal returns, and I'll tell you how we calculate this. So that's going to tell us something about financial market participants' views about these policy events. Okay, so abnormal returns, very standard methodology here. We kind of want to take out the market, right, in order to focus on the heterogeneity, and in order to take out, also account for the beta, the riskiness of different indices, right, and portfolios. So we'll estimate a market model where you regress the return of every index or portfolio or stock on the market, and it's different from the CAPM because you allow for an intercept basically, and then you subtract the market model predicted return from the observed return, and then you get what's called the abnormal return. Completely standard methodology for the last 3 decades in empirical asset pricing event studies. And just to note that we use an estimation window that ends before our events, as is commonly done, in order to not confound these estimates with our event returns. Okay. All right.
The alphas and betas are subject to pi combined, right?
That's true. That notation is overlooking that important fact. Yes. Okay. That is no one's fault. It's just, I think it's a LaTeX bug. So all right. So you had I'll stay pretty high level here instead of going through all these numbers. I mean, you had the Brown event, and that really, when Manchin said there won't be any climate policy, that was bad for all the clean energy indices, and that was, didn't have a huge impact on oil and gas indices. On the day of, if you look at the 3 day window, you had some positive returns, but they're not statistically significant here, or they're not big relative to the usual standard deviation here. The bold-faced ones are the ones that are big, more than 2 standard deviation of the stock return or index return. Right? So the Brown event had some differential effects. But the big difference really were the green events, which makes sense. That's the event that had bigger shifts in probability, probably, and more clear-cut implications. And so there you see that the green indices really rallied. I mean, they had 1 day returns, up to 7% abnormal returns. The market also went up by over a percentage point that day. And that continued for a couple more days, as you see in the 3 day returns. And then the brown sectors were losing value on those days around our event here. And then I'll move this.
Sorry, could you please say again, the bolding is some significance?
It's bigger than 2 standard deviations of the returns. So just to get an idea of, it's not a significance test, a hypothesis test, but it's just giving you an idea of whether these numbers are large relative to the usual volatility.
Got it. Thank you.
So what we take away from this is there was heterogeneity, and it was more pronounced around the the green event. Okay, so here's a little bit more of the evolution of these indices, or some of them, over the days leading up to these events and then following these events. So this was the Brown event, July 17th, sorry, so July 14th. So you had the green underperformance and the brown returns, pretty much flat. And then you had the green event here where you had a really big response in the clean energy indices, and the brown energy indices had some mixed results, but and this divergence kind of continued over the days and weeks until President Biden signed this into law. So there was some other events following that. I had them on my table. When the Senate actually voted and passed the law, and when the House voted and passed the law, and when President Biden signed it. But these were not really clear-cut, big impact events, because what really mattered was that there was an agreement among the decision makers that they made public on July 7th. And after that, it was pretty much a done deal. So that's why we focus on these two events and leave these others aside for our appendix. Okay, this is just summarizing here what we have, and the headline number is that the cumulative outperformance of the green indices was from 8 to 24 percentage points after 2 weeks. So a pretty big difference. And the takeaway is that the equity market response suggests that markets really did expect clean energy companies to benefit from the IRA, and oil, gas, and coal firms to be disadvantaged. But these are just two sectors, ones where you have nice indices for. These are about the other events, a little bit about oil prices. But there's other, so the 17 pharma French industry portfolios gives you a more granular view about the cross-industry effects, okay? So what this shows is the one-day abnormal industry return around the brown event, these are the brown bars, and the green event, those are the green bars. And it's sorted, these 17 industries are sorted by the effect around the green event. So the brown event had somewhat mixed effects. Some of these, make sense, some of them are not, it's not so clear how to interpret them. It's much sharper for the green event again here as well. And so the industries that really benefited from this, we kind of went through all of these winning industries and thought about what is in this industry. You can go to the pharma French industry classification and then think about the IRA, and it just makes a lot of sense. I mean, the utilities, a lot of the subsidies for expanding the electricity grid, for electrifying our economy, a lot of these subsidies are going to the utilities industry. Construction, there's a lot about people refurbishing their homes and energy efficient ways. Durables, EVs are not in durables. I forget why durables makes sense, but we looked at it. Automobiles, of course, that industry is going to benefit a lot. Transportation. And of course, on the bottom you have oil and gas companies. There's some other ingredients of the IRA that are not related to climate that also have an impact here. Like there's something about drug pricing, which is bad for the drug industry. That medical prices. Drug prices. And there's something about taxes that's not so good for the financial industries. I won't go into these, please.
Did you look at spillovers to foreign stocks as well, or just the US one?
We have not. Funny you mentioned this, man. We have been thinking
I
about
gotta
this.
pay him to ask this question.
Like in Australia, you had like big impacts on the fossil fuel industry there at the time.
Oh, really, huh?
That could be interesting to look at. I think.
Yeah, that's two people. I think that's really interesting. Yeah, yeah. No, and in Europe, I mean, everyone started talking about the IRA after it passed, and you know, there's pretty big negative expected effects for Europe. This industrial policy in the US. Okay, so you know what's interesting though is that these industries that are benefiting are not necessarily the green industries if you go by emissions, right? So this is a point that's so the utilities industry in particular is actually quite high emissions industry, right? It is true that the oil and gas industry is high emission and it was hurt. So a brown industry that was really hurt by this legislation, but there's not a clear correlation. And I'll get back to this a little bit. So it's really so the way we're thinking about these results is across industries, it's not about emissions. Across industries, you really got to drill down to the like incidence, which firms benefit from these subsidies. But I'll show you in a minute that within industries, there you really see a strong correlation with emission intensities and other measures of greenness. So there's like these two sides of the results here that are pretty interesting, we think. Okay, so that's just summarizing these results here. The green event producing clear industry winners and losers in line with the expectations of the effects of IRA subsidies and tax credits. It was a little bit more mixed for the brown event, and I'll show you in a few minutes that there is not a strong relationship of the cross-industry heterogeneity of the stock market response and the emissions. Okay, but let me go to the firm level effect. So because we put together, or rather Eric did put together a very nice data set of thousands of firms and their various measures of their emissions and their greenness so what we have here is really just a cross-section of firms, right? In a lot of these studies, you have very big panels. Here we're just focusing on these, two cross-sections for each of the events, really. Cross-section of firms, and we'll look at 3 measures of greenness that differentiates these firms. The first is the E-score, which is a combined metric of 3 categories: the emissions category, innovation, and resource use categories. These are proprietary measures from Refinitiv, Icon, Thomson Reuters, DataStream. That's all one conglomerate of data sources. It's all the same company. But that's a popular E-score, and we'll use it. And then there's the subcategory score, or the category score for emissions, and that's focused. I think that's based on around 10 different questions around emissions, including emission intensity. But if they don't have data for some of these, then they still come up with an emission score. They just kind of then weight the other questions accordingly. And then the simplest measure, really the most transparent one, is the emission intensity, where we divide scope 1 plus scope 2 emissions by the market capitalization of the firm. There's different measures of emission intensity. You can normalize by sales or assets or market cap, and we found that dividing by market cap worked a little bit better in our context. But all of these are common. Okay, and so we'll have some regressions. We'll also use that portfolio sorts, and I'll show you that in a minute. Okay, so Icon, Thomson Reuters, they have this ESG list, which are all the firms that have any ESG data. And if they have any, they usually have E data. Environmental data is the most commonly reported data. We use the 2021 data because our events are in 2022. There's a publication lag you got to be careful with, but the 2021 data was known to investors at the time of the IRA announcements. Yeah, so the returns, daily simple returns from data stream, and then some firm level controls to make sure that what we're picking up is really about greenness and not about size or profitability or leverage, things like that. And there we followed this Romelli et al. Paper that also did an event study. Remember about the Trump election? They use these same controls. Okay. Then we're also leaving out firms that had earnings announcements on those days in order to avoid this being confounded by earnings news. Some summary statistics of emissions here for emissions and e-scores and emission scores. Yeah, so just to mention, the scores are always between 0 and 1. And as I said before, they're relative to industry peers. So that's important to keep in mind. There's a fair amount of variation. For the emission scores and the e-scores, we have about 2,500 firms. But for a lot of these firms, they don't actually report the emissions. You got to wonder, how does Refinitiv make up an emission score if they don't know the emissions? That is a great question. That is the secret sauce of Refinitiv. They have basically some other qualitative questions and that they then put together into this score. But they also estimate emissions. Oftentimes, these providers, I need to be careful not to go too far down this rabbit hole because we spend a lot of time on these issues. But our goal is here for the emission intensity is to really just take the firms that actually reported emissions. By the way, Tesla, as far as I know, or at least until recently, does not report emissions. It seems like a pretty green firm, put all these electric vehicles on the road, but maybe in their production, they use a lot of energy and have really high emissions. So it'll be interesting to see if they, once they actually report their emissions. So we have about 900 firms in the US that did report emissions and for which we can calculate the emission intensity. And the emission intensity ranges here from close to 0 to 3.7, meaning that that's 3.7 kilotons of CO2 per million US dollar market cap. Okay, so a very skewed distribution for the emission intensity. Okay, so the cross-sectional regression here on the firm level is regressively return on some measure of greenness, GI, and some controls. Should be a coefficient there, another LaTeX bug. And then there's some industry fixed effects. That is important when you have emission intensity, which really vary drastically across industries. But we're interested not in these fixed effects because they might be correlated with the returns. And then we cluster standard errors by industries. Okay, so here are these regression results. So what we see, so we're omitting all the coefficients on the controls, just like we did in the equation. Okay, so just for the sake of brevity, right? And so we see. Let me just focus on the green event, right? For the green event, there's a strong positive correlation between E-score and the return around the event. So the one-day return around the event was higher for firms that had a high E-score. It was also higher for firms that had a high emission score. And it was lower for firms with a high emission intensity. So generally, green firms had significantly higher returns around this green event. Eric, remind me why the number of companies dropped.
Unreported.
These are the ones that
It's about earnings announcement.
earnings announcement. There's a lot of firms actually that reported second quarter earnings in that week, and so that's what explains the different number of firms in the sample. But these are kind of as expected, yeah. And it's similar, although a little bit less strong statistically. Similar as in the opposite sign for the Brown event. So you have this very significant cross-firm within industry heterogeneity that's in the stock market response to the IRA news. Okay. So in empirical asset pricing, what we like to do is sort firms into portfolios because that really reduces the idiosyncratic noise. And we can also see the economic significance a little bit more. Let me not worry too much about the details here, but I'll just show you these portfolio returns. So on the right here, you have what we sort firms into 10 portfolios depending on their E-score. You see that the portfolio with the firms that had the highest E-score had a return of, like, let's say 0.8%, and the portfolio with the brownest firms had a return of about minus 0.7%. So about a 1.5% difference in the returns here. And it's the other way for the brown event. Sorting by emission score and emission intensity here leads to qualitatively similar conclusions. And here you can also easily see the magnitude. I mean, 1.5 to 2% maybe is the difference in return. So a significant difference for as an average difference. This is the average return for these portfolios, but it's not like a massive or destabilizing loss of value for brown companies, right? So that's important to keep in mind. Yeah, and you see here that in the middle of the distribution, they're much more similar. The differences are really driven a lot by the brownest and the greenest firms. Okay. All right, so let me talk a little bit about the industry level returns, just real quick. So the reason we want to look at this is, first, we were struck by the fact that across industries, it's not the fact that green industries really benefited and brown industries really were hurt. It was a lot more subtle. And the second reason is that in this literature, it is becoming common to not even look at the firm's individual data, but to just look at which industry is a firm in. For example, when you look at banks and financial stability risks and stress tests and banks' exposure to transition risk, some people are looking at the loans that banks make to firms and just look at the industry of the firm, right? And so the industry affiliation of a firm is becoming kind of a more and more often used measure of its risk exposure. And what our results show is basically, at least in the case of the IRA, that is not a good idea. It's really not about, you can't say, here's a green industry, this company is in a green industry, so it necessarily benefited from the IRA. Instead, for example, utilities was a very brown industry that did benefit substantially from the IRA. So, we'll just aggregate returns and also these E and emissions measures across industries. And we also use this other measure on the industry level about how sensitive this industry would be to a carbon tax. And this measure has been used in other papers that look at industry level risk exposure. Right? And we find basically no correlation at all between the event returns and these measures of greenness. Here's as an example, the emission intensity of the industry and the return around the green event. And here you see exactly what I said earlier, that utilities is number 17, had a very positive return, but it's a pretty brown industry. And then 11 is oil and gas, is almost as bad. Actually, utilities is a little worse in terms of emission intensity, but had a very negative return. So it's really important to drill a little deeper and look at each firm individually. And instead of just looking at industry level greenness. And this is just a table showing that if you regress if you have industry level regressions, you get the wrong sign and absence of significance, usually, okay? But I see more and more people gathering outside. So I want to make sure that we have a little bit of time for questions. So let me just conclude here. So what we do in this paper is we investigate the financial market response to the news that the Inflation Reduction Act, the biggest climate policy in US history, was becoming a reality. The responses are pretty substantial, overall consistent with greenness measures across firms. Green stocks outperformed when the climate policy was announced. At the industry level, there's not a lot of correlation between greenness and the stock market response. So this suggests you need a more granular, firm level approach to assessing transition risk. And you need to really look at the specific measures in the climate policy package to understand how it affects different industries, which is what we did in this paper. So I think one takeaway is that this was extremely ambitious climate policy in terms of dollar volume, impact on CO2 emissions, et cetera. And it had effects on the stock market, very heterogeneous effects, but it did not cause any disorderly or dramatic repricing major stranded assets akin to a climate Minsky moment. So maybe this is evidence that we don't need to worry so much about financial instability when it comes to climate policy action. Okay, so left a few minutes for questions if there are any. Or comments from my co-authors, something that I said wrong or overlooked. I can't see the online crowd so well, or the chat. I assume that you would alert me to any questions there, Lisa, if there are any hands up or chat questions.
I would, but I of course have more questions. I've well, maybe others have questions before I jump in with some of mine. I know we have only a bit of time.
There's no questions in the room, so why don't you go ahead, Lisa?
Okay, well, you were comment here about no dramatic or disorderly repricing, but of course, we're in it for the long haul here. And while I understand that trying to measure these effects over return horizons that are much longer than the ones you considered might be impossible, it also feels relevant. And I wonder if you could comment on that. We're looking at a short times around an event, and really, in my mind, of course, is what's going to happen in 10 years as a result of this.
That's right. Yeah. No, so it's harder to get statistical evidence about the longer run effects in the stock market because there's so many other things happening in the market. So you don't really know, what you can attribute to the IRA. So we can't yet look at 10 years, but what we can do is we can kind of look at, so we can get some evidence of what's happening, what the effects have been since this package. This is close to a year and a half now, and we have some ongoing work where we look at the stocks that really benefited on the day of, and the stocks that were really losing out on the day of this announcement, and then sorting them, building like a long short portfolio and saying, these are the IRA winners versus losers. How have they been doing a year later? Right. So that's kind of getting a little bit to your question, but yeah, the longer run effects are very uncertain also because, future administrations might undo some of this.
Right. So are there any papers that attempt to look at longer horizons that you know of?
I mean, there are a number of studies that look at this from the, climate economic modeling perspective, right? That model, that use macroeconomic models augmented with, climate modules, and that use assumptions about the impact of the IRA and feed this through, and that was feed this through this model. And that's some of those results I mentioned earlier were they look at the effects on the likely effects of future emissions and the likely effects across firms and industries down the road. But you need a lot of modeling assumptions to do that. But my slides have a few references. I'm happy to provide more. Yes, there are papers that do that and project long into the future using some admittedly strong assumptions.
Yeah, necessarily. On that subject, are we able to post this recording and your slides and stuff in your paper on our website so others can appreciate them and get those references?
Yeah, not a problem, yes.
Okay, that's
I just want to add something with the long run effects. Yeah.
Well, the long run effects, again, one of the reasons we focus on financial markets is financial markets, financial instruments, equity prices. They have that long horizon outlook, and so they collapse all that information to the present time. So the addition of a passage of a carbon tax doesn't just affect your revenues in that year, but maybe makes that business model less profitable going forward. But all of that horizon, all of the effects of that horizon get pulled forward to the current equity price. And so that's why people are particularly worried about this disorderly repricing once investors wake up to, well, they are going to have this new climate policy, and that changes the landscape going forward.
Exactly. I mean, this is kind of the idea here. We are looking at only one-day returns, but because stock prices are long-run assets, they are ideally telling us something about the anticipated long-run economic effects.
okay. Well, I'm not there, but I do know from experience that we lose a bunch of people come running into the room from the hall in about 3 minutes. So I should probably thank you for an awesome talk. Let's thank our speakers. And really, really very fascinating, very timely. And want to mention that next week we'll be here again, but this is going to be an entirely Zoom talk. Ruimeng Hu from UC Santa Barbara, Probability and Statistics, will be presenting. So please watch announcements for information about her talk, which will also be posted on our website before too long. So thanks very much for a great talk. Thanks, audience, for joining us. And hope to meet you speakers again in person before too long back in the Bay Area.
That would be great. Thank you, Lisa. Thanks for the invitation. Thank you, everyone, for coming.
Bye now.